Hi guys, what's up? This is another episode of our usual weekly Zoom training and educational videos for Golden Ticket. My name is Dmitry, and this week we are focusing on swing trading using Bollinger Bands as well as using our moving averages. However, we have been using a 10 and 40 day setup where now we will be focusing on two, and that's the 200, and that the 200 is going to be exponential, and we're going to be focusing on the 9 instead of the 10, and that's going to be a simple moving average. So we have a 200 EMA, 9 SMA, as well as the Bollinger Bands, which are going to be set at a default setting. You do not need to alter them like we did with the Keltner channels. What do I prefer? If that's what you think, is since I did a video on Keltner channels and I did a video on the Bollinger Bands, and now we're going into Bollinger Bands for swing trading, I prefer Keltner channels. And in this video, I will personally go over the Bollinger Bands and the Keltner channels and show you the comparison. So at the end of the video, it's going to be up to you to make up your mind on which one you prefer to use. With that being said, let me open up our live trading account and backdate it. For those of you that do not know, you could do back testing on almost any platform. Now, I will say this, I do always recommend TD Ameritrade. However, if you prefer Webull, you could do back testing on Webull. And there's several other platforms that you could do back testing on. Okay, so we're going to click on demand. And let's go to Tuesday, August 3rd. And we're going to make it at 9:30 a.m. Okay, so now we are literally, well, according to the software, it thinks that this is 9:30 a.m. on August 3rd, or 9:33. So the market just opened. We could see that ABIR is crashing. Let's pull up a more, live stock. And when I say live, I mean like more active, NVIDIA. So NVIDIA is clearly skyrocketing. Now, what's it probably going to do? It's going to take a dip soon. Why? Because I could see that it is flying up. And we're going to remove all of our studies. There you go. Now we have no studies left, and we're going to re-add them. I'm going to go to edit studies. You could do add study. When it comes to Webull, you can always, go to the same thing, except instead of studies, you are going to click on indicators, which is going to be in the top left corner, and then you will add your indicators. And we're going to add the Bollinger Bands. We're going to add our SMA, which is simple moving average. We're going to add our exponential. And of course, as always, you should always have these two indicators, no matter what. I don't care what you're doing, RSI and MACD. And for MACD, go for MACD histogram. Okay, so our simple moving average, we don't even need to touch. It's already on 9. Bollinger Bands, we also don't need to touch. They're already good. What we are going to configure, though, is the colors. Now, for our Bollinger Bands, we want our middle, we could leave it at blue. Lower, we want it to be, my preference, always, you could always change the colors. I want it to be red. Why? Because it's lower. And upper, which is already red, this is why I change it, I want it to be green. Why? Because it's the upper band. I'm going to click OK. Now I want to make sure that my simple moving average does not conflict with any other lines. So I'm going to go there. And see, my simple moving average would conflict with my middle Bollinger Band. So that's going to go to, say, like a light gray. And my moving average for the exponential, the EMA, we do have to edit, and we will change that to 200. Why? Because we want to look back 200 days. We don't want to look back 9. And we're going to change the color to purple. Okay. Now, RSI, MACD, for this, particular purpose, we could just leave it as is. So I'm going to go apply. Okay, now before I start doing my studies, I told you this was about to fall. And there you go, it's fallen. How did I know that? This is a classic setup where the stock is running up pre-market and then it shoots up. Now, once it hits that high, the natural thing is people are going to take profits. There are day traders that are, day traders usually trade from 45 minutes, maximum 60 minutes for experienced day traders per day. So what they're doing now here is they're selling off. So the stock is going to go down a little bit. It might move back up. Usually it'll go down even more than this. Now, let's take a look at our Bollinger Band. So I'm going to zoom in on here so we could take a look. These are Bollinger Bands. The green one is on the top. Blue one is the middle. Red is the low. Now, since this is swing trading, and right now we're looking at a 1 day, 1 minute chart, our chart is wrong because you can't look at a 1 day, 1 minute chart when you're trying to swing trade a security. So what do? We're going to expand the chart. And what I always recommend is going for the 1 year, 1 day. Some people will, prefer a weekly chart. Some people prefer a monthly chart. However, I like to see it where every candlestick represents 1 day. So we're going to do that. And right here, it's a daily chart. 1 year, 1 day. The entire chart represents 1 year. Every candlestick represents 1 day. I'll explain why that's important for swing trading in a second. Why do we use a 1 year, 1 day chart when it comes to swing trading? It's because we want to see the securities performance on a daily basis instead of a 1 minute basis. Some people, they'll tell you use a monthly chart. It's all garbage to me, in my opinion. Now, please keep in mind that this is, backtracked to August 3rd. So it's not on the current day where we're right now, while we're recording this September 12th. And I will explain to you how to swing trade with Bollinger Bands, how to use the 9 EMA, the 200 EMA, and we're also going to take a look at, several examples. So we're not just going to look at NVIDIA the whole time. So our gray line right here is a 9 EMA. Please keep that in mind. It looks like I may have forgotten to apply the 200 EMA color and the 200 EMA line. So there you go. Now we have our 200 EMA. So how do you swing trade using Bollinger Bands before we go into, the comparison to Keltner channels? It's very similar. You take a look at your daily chart on any security, and you will notice that every single time that the price level falls below the 9 EMA, the 9 SMA, I'm sorry about that, it's gonna go down. So right here, the price level crossed below the 9 simple moving average and began to fall. Once it crossed back above with a single solid day confirmation candle, the price began to rise. And as you could see, it's staying above the 9 EMA. Here, on this day, which was 7/8, it crossed again below the 9 EMA, the 9 SMA line. And while these 2 days were green, look what happened right afterwards. So it's like a fake out. It's like a reversal. So that is how you use the 9 SMA, which is simple moving average. How do we use the channels? You really, on the safe side, do not want to buy in when a security is hitting its upper band from Bollinger Bands. And the same thing is going to apply for Keltner channels. Why? Because you're taking a risk. Here, yes, it's going up, and yes, you could have made profit. However, the risk that you're taking is it could go into a correction at any day, which it did right here. And it dropped. So if you would have bought in here, you would have been negative day 1, day 2, day 3, day 4, day 5 possibly, as well as day 6 and day 7, if you, especially if you're playing options, because you have to take into account, time decay, which comes from the Greek code theta. So the place you really want to buy in is when it gets either A, and this is, up to you. I'm not going to tell you exactly when. You're going to have to be able to see the 9-day simple moving average and when it's crossing above it, as well as the channels, but usually either A, on the middle channel, or B, on the bottom channel. Or in this case, since this is Bollinger Bands, they're bands. So what do I prefer? I always prefer to wait until it hits a position like this, where it's touching that, bottom band, because it's the safest. You know that, yeah, it could break the bottom band. However, that's where this 200 EMA comes in. The 200 EMA is the ultimate resource that you need to use in order to determine where a stock price is going. If it is below the 200 EMA, it's going down. It's going to turn around at one point, and as it approaches back to the 200 EMA, it's going to still be on the bottom band for Bollinger, and when we get to Keltner for Keltner. But at least you're going to know, we're moving back up. This is a good time to buy in. I want to buy low. I want to sell high. To give you an example, let's find a time when NVIDIA broke its 200 EMA. There's not one on this chart. So we're going to go to MSFT. Like I said, we're going to swap, symbols. Let's see if there's one here. Unfortunately, there isn't here. Let's do something that is cheaper and more people play. So this way we could see some, manipulation and movement in the price. Let's do MARA. Okay. So right here, it broke its 200 EMA. Next day, it was still a red day. Now it's still riding that bottom channel. And you could see that it's still not even approaching that 9 SMA, which is simple moving average once again. But here you could see we entered a range, which is it's going sideways. And here it breaks the 9 SMA and starts to go away from the 200 EMA. So if you were to see this day, you could have bought today, which would have been 525 at around $22.30, and sold 527 for $26.04. 2-day hold, easy money. If you decided to hold, even further, you'd see that over here was a little risky, but it just bounced off of that 200 EMA again, because if you could tell, if you look really, really closely, that's called the wick. Every candle has a wick, and what the wick represents is the high point of the day, like where this, price is touched for sometimes milliseconds and went back. And if you want to learn more about candlesticks, we do have a YouTube video on our channel, and regarding candlesticks and how to read them. And then This day would have been your confirmation to buy. Now, yeah, you wouldn't have bought in at the cheapest price. You would have bought in here if you were actively trading. Its lowest price of the day was 24.47. And when you saw that price break this upper channel or band, you could either sold here, which is 29.73 compared to your optimal buy-in of roughly 25.52, or you could have sold the next day for anywhere from 30.39 to 27.89. However, like I said, once again, it's a 3 to 4 day hold, and you're not losing money. Even if you sell on this day or this day, you wouldn't lose money. Why? Because you bought here when it was just crossing back over that 9 simple moving average, 9 day simple moving average, and your confirmation would have been right here. So what are you looking for essentially on how to enter? You have a variety of topics that you could use to your advantage, or indicators. One, you could look for a bounce off of or from under the 200 EMA. Then you could also confirm when the price is dropping, because it's going to look like it's beginning to dip below the 9 day simple moving average. So that's your exit. Then you could also confirm it by looking at the 9 day simple moving average when it's crossing back over it, which is giving you another entry point. And as I said from the very beginning, once a security, and the reason why I say security and not stock specifically is because this could work for, say, ETFs. And I'm going to bring up that example in a second. Once it hits this lower red band, you want to wait and you want to look like over here for that first green candle confirmation to show you that the price is moving up to enter. How do you verify? The RSI, the MACD come into play. Now, as I've explained before, as the red gets bright and redder and bigger upside down, that means more and more selling, which goes right to back here. Then as the red begins to fade out and get darker and start getting smaller, which is from right here to here, you know that there's buying going on. And then the same is for the green. As the green is bright and green, that means there's volume and there's purchasing and things are going good. But if we look right here, as it begins to fade and get smaller, the price begins to drop. As you can see with the vertical line, how it corresponds with those 3 red candles on the chart. Now over here, yeah, it had a little boost, but this was what we call a fake out. How is this confirmed on this day? Via the RSI. We could see that the RSI is beginning to curve down. Now, on this day, we see the RSI is curving down now for 2 days straight. So if the RSI is beginning to curve down, we know that the money is beginning to fade. We also see it on the MACD. So would you hold past this day if you bought in here? No, because you could see that every single indicator is showing you that volume and price, the money flow, we could even add the money flow index to this, is beginning to go down. So if you bought in here and you were swing trading at 23.55, and you even held it to this red day at $30, and let's see, what was the bottom point, about $30.65, that would have been your time to sell. Why? Because you saw this day right here. And once again, I'm going to refer you back to the candlesticks video that we do have, because it's going to explain like what these candlesticks mean. And a candlestick like this usually indicates that the bearish and bullish flow were pretty much even. So I'm going to go over one more security or one more stock, I'm going to say this time, for swing trading. And then we're going to switch it up. We're going to go to counter channels. Let's see. What do we want to look up this time? Let's go to BBIG. Now, this is a heavily manipulated stock. I don't like to look it up. However, I do want to show you guys stocks that are on stock twits, because I know a lot of you guys like to play them, and usually they are between the $1 to $10 range. I want you guys to be able to see how to play them. So BBIG, you know, it's the same exact thing. If you take a look at it, once the price is approaching the fall, which is this day right here, and you can see that the wick touches the 9-day simple moving average. Once that price starts to approach that area, drop. Then this day you have, you know, pretty much a range, a sideways, you know, day. But you could see that the bulls are beginning to take control. It breaks over the 9-day SMA just for a day. And then it begins to fall right below it. So what are we going to look at next? We're going to look at the 200-day EMA, which is exponential moving average. It's below the 200. And like I said, if the stock is below its 200-day exponential moving average, it means the price is going down. As it approaches its 200-day moving average, you could be assured that the price is on the way up. It's going to go over it, and then it could drop below it again, like it does over here. Now, if we were to talk about it in regards to bands, over here, it broke that, you know, top band, and on this day too. But as I said earlier, once it hits that upper band, if you want to stay safe when it comes to swing trading, just sell. One of the biggest mistakes that I see traders make very, very often is they chase. If you're making profits, take your money and get out, especially with stocks like BBIG. I mean, you know, over here, it hit 535. If we follow the wick, we had a high of 606. Next day fell, and next day, you know, back up, and then boom, huge drop down to $4. After that, yes, boom, again, it got pumped. After that, huge drop again to $3.51. But if you look at the pattern throughout it, you know, this right here, it was just in a range, nobody was paying attention to it. But if you follow the pattern, every time it bounces off of this 200 EMA and the lower band, it begins to move up. And then it goes back, well, you know, once it breaks that upper band, it goes down. Again, crosses below the 200 EMA, begins to, you know, bounce off and approach its 200 EMA, goes up, goes down. Same thing here. It's approaching the 200 EMA to break it. Once it breaks, it shoots up. Once it hits that upper channel, shoots back down, goes below the 9-day SMA, starts to begin to approach it again, goes up and down. That's why they call it swing trading. You're literally swinging along with the price of the security. Now, do you have to make money only when it goes up? No. You can make money when it goes down. All you have to do is short it. So say, you know, you bought it over here, you sold right here, and you reversed your position. So you went from owning 500 shares, you sold your 500 shares, and then you sold an additional 500 shares. What that means is you're selling shares that you do not have. Essentially, what you are doing is you are borrowing shares from your brokerage. And this is when you begin to make money on this day, and you close that position out right here. So you made money going up, and you make money going down. If you sold, some of you might be thinking, okay, so I sold 500 shares that I do not have. How do I close that position? I'll explain it to you. you have an option. It's called buy back to cover. So that's how bears play the market. And that takes me back to the very, very beginning. Maybe even to before I started recording, where I said I will show you how to play a bear market. You could sell shares that you do not own. It's called short. When you buy shares, it's called long. Same thing with options. You buy a call, you're betting that the price is going to go up. You buy a put, you're betting that the price is going to go down. You sell a call, then you're hoping the price goes down. You sell a put, you're hoping the price goes up. So as you can see, it's an inverse. You know, each one is the inverse of its counterpart. So you could have made money going up, then shorted the position, made money going down, rebought the position going up, shorted the position going down. And that's how you essentially make money regardless of the kind of market you're in. If it's a bear market, if it's a bull market, or bearish, bullish, whatever you want, you know, however you want to call it, everybody has their own ways, but that's how it works. So with that being explained, now you guys know the 9 SMA, 200 EMA, and the Bollinger Bands, which are going to be essentially at all of their defaults. And remember, the first green close, which is this, the first day that it closes green after going red, is your optimal buy point. Your optimal take profit point is once this green candle breaks above the upper band. You could hold it for longer. Would I recommend it? No. Why? Because you don't want to get greedy. Even, sorry about that. Even if I bought in here. So I saw my first green candle. I see it's approaching the 9. I see it's above the 200 EMA, I'm sorry. I see the RSI is going up. I see the MACD is climbing. And I buy in here. So I wait for the lowest point. Usually, it's either early in the morning or the lunch dip. And so I bought in the middle. 317, I sold right here, or even here, if I really want to risk it. At 437, I held for one, the first day, second day, third day I sold. I don't use a day trade, and I make my money. Okay, yeah, tomorrow I see it goes up again, but guess what? I'm not risking holding it from here and selling it here. So, it's better to just take your money and walk away than to continue risking it. Let's do a casino analogy. If you're up on the craps table, you don't keep betting money because you're up. You take your money and walk away. The way the casino is making money, and in this case, the casino is the market itself, funds, people who are shorting these stocks, is they want to keep you in the game. They, the longer you expose yourself every single day in a position, that's risk that is not only multiplied, it's exponential. Now, with that being explained, again, we're gonna go to studies. Edit studies, we're gonna remove the Bollinger Bands. We're gonna keep the 9. If you want to learn about the 10 and the 40 SMA strategy, then just watch some of my previous videos. Like I said, they're all available on our YouTube channel. Feel free to subscribe and turn on alerts, so this way you know every time I post a new video. I'm gonna go to Keltner channels. Now this we are not going to leave at default. We're gonna go to edit. Once again, average. We can leave it blue. Upper band, I want it to be green. Lower band, I want it to be red. And over here, for factor, you're gonna change it to 2.25 instead of 1.5. Very important. If I want, I'm gonna read you pretty much TD Ameritrade's standard definition for the factor. But essentially what it is, it's the pricing between the channels. So the factor by which the average true range, which is what ATR stands for, value is multiplied to calculate the distance. And the distance is the distance between the channels. And the channels are basically indicating the price. The study parameters and data use historical market data and information gathered by TD Ameritrade. All output is for informational and educational use only, and is not an investment recommendation or advice, as well as this entire YouTube video. So what is the factor doing? It's literally giving us more space between the channels, which is giving us less risk in return. With a 1.5 distance between the high, middle, and low, we are exposing ourselves to more risk than with a 2.25 because we want to catch that price when it breaks below that bottom channel, and it happens. And that is like pretty much the best protection you could get. You don't want to, be that guy that buys at the bottom channel, but then the price keeps falling a little lower. You want to buy at just the right time, and I'm going to show you exactly how it works. Apply. Okay, so over here, because I expanded my channels, it hits this, bottom channel and then rebounds. Here it, breaks under the 209. And then we could see a rebound beginning. Now, let's change it back from 2.25 back to 1.5, the default. Here you would have bought because you would have thought that it's about to rebound off of the bottom channel. And then for 1, 2, 3, 4, 5, 6, 7 days straight, you would have been losing money. Now that's an average rookie or beginner mistake. Some of these indicators, they have to be custom tuned. They have to be fine tuned. It's not one size fits all. Same thing over here. It actually does hit the bottom channel, but when we had it to 2.25, it didn't even touch it. Why? Because we gave ourselves a safety net. So again, we're gonna go and change it back to 2.25. Okay, apply, done. Now we could see that it actually just bounces off that bottom channel and then proceeds up. Hits the top channel, goes down. And we could see that this day right here, it's already, breaking. And on this day, we could see it was a red day. So if that's not an indicator for you to sell, then I don't know what is. And we could see that the RSI is beginning to fall on this day. Right here. You could see that little turn down. And we could see that the MACD is pretty much peaking. So, on this day right here, if you bought on this day, for example, this day should have been your clear indicator to sell. The MACD is turning dark green. The RSI is beginning to fall. You got a red day and it touched that 9-day simple moving average. You don't want to stick around for this day because there go all of your profits. So as you could see, the Keltner channels and the Bollinger Bands are very similar in how they work, so on and so forth, and how to read them. Why do I prefer the Keltner channels? It's because I could expand it to 2.25. And I'm able to read my other indicators. I could still use the 9, even though personally I don't. I use 10 and a 40 to watch for crossovers, but you could watch that in our previous videos. I believe it was in Basics 101 to 103. And, so it's up to you. I mean, Bollinger Bands, they're great. I'm not gonna, say they're not a good, it's not a good indicator. My preference is Keltner channels because I feel that with a 2.25 setting on the Keltner, you know, I have a much less chance of losing. And there are other traders other than me who back tested this strategy for 20 years back and came back with a win rate that is constantly bringing in money. What we're doing right now essentially is back testing because right now, according to TD Ameritrade, it's August 3rd, 10 a.m. If I wanted to day trade this, for example, I could go to 1 day, 1 minute, and I could buy when it hits this bottom channel or this bottom channel. And I just watch the RSI, I'll watch the MACD, I'll buy, and then I'll sell when it's approaching the upper channel. That's how you day trade. It's the same thing as swing trading, except on a much shorter scale. So, the window of time you're playing with, instead of 1 year, 1 day charts, you're looking at 1 day, 1 minute. Some people prefer, 1 day, 5 minutes. Some people even do 1 day, 15 minutes. Because, basically, that's the difference between day trading and scalping. Scalping, you try to take off pennies on multiple, plays, multiple, entries and exits. You could also, like I said before, you could open a short position after, you write it up from here. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 minutes. And on the 19th minute, you'd sell because you would see this candle. And then you could see this candle, which means, that bearish and that bullish fight is starting to turn around. The sell-offs are coming, meaning that people were taking profit, people were selling. And this right here would be your indicator that, we might be seeing some red. How else do you determine that? You look at the RSI, it's starting to move up. You look at the MACD, you see, this is minutes. You see that it's starting to fade out and go into the green. So that's your moment to buy. You buy it right here, $3.33. You sell it right here, $3.39. You just scalped. But if you say, let's say you bought 1,000 shares, that's 6 cents went up. And what is 6 cents with 1,000 shares? You're making $1 per cent. So you walked away with $60. Then, if you want, you can short it, make some money on the way down, but this is for a stock in the $3 range. But what if you were playing a stock like NIO, which is in the $40 range? So right here, you see that it, goes below the 9 EMA, and you see that this streak is over. The RSI broke its support and is about to move up. This is called a dip and rip. So you would have bought in right around here at 44.61 and sold here for 45.68. Now, even with shares, that's a good profit for 5 minutes of work, especially. What about options? Say you bought 10 contracts. You could have potentially walked away with hundreds of dollars. Depending on, as you know, options, the payout and the price is always going to be different. It depends on the implied volatility. It depends on your expiration date. Some people will buy options that end on Friday if it's even a Thursday. Why? Because they plan on selling them that day and it's cheaper. However, buying options with a further out expiration date not only gives you higher returns, but it also assures you that you are going to be safer from losses. Why? Because the theta, which is the time decay on an option, it kicks in. And what if your trade goes wrong? It does happen. I showed you guys, an example of reversal earlier, and they do happen. I could probably find one just on this chart right here. Let's see. If you bought an option, say after this right here, because you thought, okay, it's starting to turn around, it's now above the 9, and 5 minutes later, that's what you get. Now you're going to be panicking, obviously. And even if you held till here, you haven't recovered. So that's why, if you're playing options, if you're not planning on, selling this the second you get profits, then always just for your own security, get yourself a nice expiration date where you don't have to worry about that data, where you don't have to worry about that time decay. If you are stuck in a options position where your expiration date is coming and you're losing money, you always do have the, option to roll the option. So, I'm going to show you guys how it's done just for the sake of the example. So we were looking at NIO and say, it's all good. According to this, it's August 3rd. So I purchased August 20th. I wanted to do a 44.5 strike. I bought 10 contracts, whatever, confirm, send, boom. We got the option. So now we have NIO. We're currently losing $5 on our delta is 518. Our theta is 77. Now we're losing 10. And say it's approaching that expiration date. And I don't want to just, give up on my money. I want to give it a chance to recover. You could always go and you could create a rolling order. So this one automatically assumes that I want to go from August 21st and I want to roll it to another day, which is August 27th. So what are we doing? We're selling one option and automatically buying another. Now, obviously, I don't want to, I wouldn't go for the August 27th. I go for the next month. You could always then analyze them also. So if we want to analyze it, you're going to, bring up a nice analysis right here, and it's going to show you if, I'll do another session on how to do probability analysis and risk profiles later on. I just don't have time for it right now, but we'll probably do that for our next Zoom session. However, there are tools like this which will show you the analysis and the probabilities of where the price will be on what day. Like I said, I will do that on our next Zoom session, and you could do this not only for options, but you can also do it for stocks. They have probability analysis for securities, just stocks as well. So now you guys saw how to roll an option. You guys have seen how to use Bollinger Bands. You guys have seen how to use Keltner channels, dip and rip, 9-day simple moving average, 200-day exponential moving average, and how to tie those into the RSI and MACD. As you can see, by the way, if this was a real trade, just in the time that I've been running my mouth, we would have already made almost $100. So with that being said, let me sell this, fake order. There you go. So, we would have made $80 in about 2 minutes. And, that just gives you an example on why I say options are a very, very fast way to grow small accounts into large ones. However, if stocks are your thing, I'm not going to tell you not to play them. And I will be doing alerts for, securities of all prices from 0 to 20, from 20 to 100, and 100 and above, which remember in the VIP alerts are going to be denoted by the asterisks. One asterisk is the 0 to 20, 2 asterisks is 20 to 100, 3 asterisks is going to be 100 and above. So that is going to be a lesson for today. Once again, this is Dmitriy from Golden Ticket. If you are not on our Discord, the link is below, as well as in our YouTube profile. Don't forget to like, subscribe, turn on alerts so you can get our future videos. And I will see you guys on Discord. Thank you for tuning in tonight. Before you go, here are 3 free ways that we can help you become a more profitable trader. You can join our Discord channel. Also, subscribe to our YouTube channel for all the latest videos and like this video. Thanks everybody for watching. More videos to come. We usually do them once a week, and I will see you later.